So, what if I told you there was an AI stock that looked absolutely perfect? I mean, on paper, it seems like a total sure thing. Well, today, we're going to dive into a real head-scratcher. We're going to try to unravel the mystery of an AI powerhouse that looks unstoppable, but just took a massive, massive hit.
Okay, first clue in our mystery. NVIDIA. You know, the undisputed king of AI chips? They have placed a monster bet on this one company. We're talking a nearly $4 billion stake. That makes up over 90% of their public stock holdings. You guys, that's not just a vote of confidence. That is a mountain of conviction from the single most important player in the entire industry.
All right, next up, let's talk about growth. We are not talking about little baby steps here. This company just reported that its revenue tripled. That is a staggering 207% jump from this time last year. You just don't see numbers like that from public companies. That's startup territory.
And here's the twist. This is where our story gets weird. Despite that massive NVIDIA backing, despite that explosive growth, the stock just crashed. It plummeted 45% from its recent highs. So how does that even make sense, right? Well, it seems a perfect storm of factors created this huge disconnect between the actual business and its stock price.
The company at the heart of all this drama is COREWEAVE, ticker symbol CRWV. So now that we've set the stage, let's get into it. Let's figure out what COREWEAVE actually does and why it's getting so much attention, both the good and, well, the really bad.
Okay, so to solve this puzzle, we have to start with the business itself. And COREWEAVE is built on a really simple but incredibly powerful idea that puts it right at the epicenter of this whole AI gold rush.
COREWEAVE's whole mission is to be the Amazon Web Services of AI. Now just let that sink in for a second. They provide the essential tools, all that high-powered GPU computing that AI companies desperately need, but can't afford or, wait years to build themselves. They give them instant, on-demand access to the digital horsepower that is literally powering this entire AI revolution.
Here's a great way to think about it. COREWEAVE is basically like a peaker power plant for the world of computing. So when these giant cloud providers, think Microsoft Azure, get totally slammed with demand for AI, they get these huge spikes. That's when COREWEAVE steps in. They provide that critical overflow capacity, preventing what you might call compute blackouts.
So who's buying this stuff? Well, it really breaks down into three key groups. First, you've got the huge AI labs like OpenAI. They need a colossal amount of power to train their next-gen models. Second, you've got the hyperscalers, like their biggest customer, Microsoft, who need them for that peaker plant capacity. And third, you've got everyday companies who are just looking for easy ways to start using AI.
And if you want to get a sense of the scale we're talking about here, just look at OpenAI. Yeah, the people who made ChatGPT. They've signed contracts with COREWEAVE that add up to a mind-boggling $16 billion. They're betting billions that they're going to need COREWEAVE's specialized gear to build their next world-changing models, like GPT-5.
Okay, so the business model is solid. The demand is absolutely off the charts, which brings us right back to our central mystery. Why on earth did the stock get completely hammered? Well, it turns out a few very specific fears all collided at once to create this perfect storm of negativity.
And this is the question that just totally spooked the market. With a business this solid, with customers like Microsoft and OpenAI locked in for billions of dollars, what could possibly justify a 45% drop? It turns out the market got laser-focused on three specific numbers in their latest earnings report. And here they are, the three big boogeymen. First, a headline net loss of $290 million. Ouch. Second, a huge amount of stock-based compensation, which investors worry will dilute their shares. And third, a bunch of insiders started selling their stock right after the IPO lockup ended. Yeah, on the surface, that looks pretty darn bad.
But hold on. This is where the story gets really interesting. Because if you actually look closer, the real story behind each of these fears starts to look completely different.
So let's take that big, scary net loss. The market sees a $290 million loss. But what's really happening? The company spent nearly $3 billion on capital expenditures, that's CapEx, this quarter. They are not losing money, they're investing it like crazy into building out data centers so they can service the $30 billion backlog of contracts they already have signed.
Okay, fine, but what about all that stock-based compensation? Yeah, the fear is delusion, but the reality is that in the hyper-competitive world of AI, there is a full-on war for talent. Top engineers are incredibly rare.
Stock compensation, well, that's just the price of admission to get and keep the smartest people you need to build a business. It's a necessary cost of growth right now.
And finally, the insider selling. The market panics, right? They think the people who know the company best are jumping ship. But in reality, this is completely normal. It happens after pretty much every IPO. The lockup period ends, and the early employees and investors finally get a chance to cash in on years of hard work. It's a predictable, short-term event that actually creates a great entry point for long-term investors.
So here's the crucial point. Investors like NVIDIA, people who are deep in this industry, they aren't scared by these short-term headlines. They have 4 billion reasons why they believe in the long-term story. They can see the forest, that massive, unstoppable demand for AI, and they aren't getting distracted by a few scary-looking trees.
Now that we've kind of reframed those fears, let's look at the numbers that, according to this analysis, paint a picture of a pretty incredible opportunity.
This number, this is the whole ballgame, $30 billion. That's how big CoreWeave's revenue backlog is. That's future business they already have locked in, signed, sealed, and delivered through multi-year contracts.
And so what happens when you plug that kind of stability into financial models? You get this. According to an analysis from Simply Wall Street, at its current price, the stock is trading at a 55% discount to what its fair value should be.
Let me put that another way for you. Just for the stock to get back to its current fair value, it would need to rally 120%. That really suggests that this recent crash was a massive market overreaction.
So, let's just boil this all down. What's the takeaway here? First, the business is incredibly stable, built on predictable contracts. Second, their huge backlog is actually growing way faster than their spending. And third, every single dollar they spend is a direct investment in growth, getting power, building data centers, and hiring the best people.
Honestly, this might be the best way to think about the whole thing. During the gold rush, the surest way to get rich isn't always digging for gold yourself. It's selling the picks and shovels to all the miners. That's CoreWeave. They are supplying the essential digital tools for the entire AI industry. And that leaves us with one final big question. Is the market seeing fatal flaws that signal a broken company? Or is it just mistaking the necessary, even predictable growing pains of a company that is scaling at historic speed to meet unbelievable demand? The market has made its short-term bet. The long-term answer? Well, that's still being written.